Hello guys, glad to have you on board again today. We're going to keep on going with the previous series regarding the trend podcast. It's still in a series of 3 videos, but we're just going to do something a little bit different today. We're just going to bring an additional 4th video in between the first and second parts. So I'm just basically going to call part 1 dash A and dash B for these today's podcast, because yes, we do need to add some information to what's been said previously. So you know that what I'm teaching you guys in here is most likely what I use the most, which is trading stock markets and conventional markets, in which normally the liquidity is far sufficient enough to sustain speculative activities. This is not necessarily going to be the case on some other markets or at some markets at a temporary given time. So to set this real clear, I'm definitely talking about cryptocurrencies here and some other stuff like that, in which at some given point, speculation will overcome the potential underlying liquidity structure, which means people will speculate on an asset that doesn't necessarily have enough liquidity to handle those speculative positionings. And that will totally destructure the overlying thing, and it will change the way these assets trend. Because remember that trending is when we move prices from point A to point B, and there are multiple ways of doing it. There are some resonating ways, the ones I tried to teach you throughout this PDF manual and throughout my teaching of trading. But the thing is that it is not the only case scenario. And recently I came across a lot of troubles because obviously many people read this PDF and try to use those rules, but they use it into very speculative assets, and specifically talking about cryptocurrencies in here. And some of you guys are just not trading conventional market, and you're learning trading uniquely and only with cryptocurrencies, which is going to cause a few problems, because obviously as long as you're dealing with ranges, everything should be fine. Both assets tend to use the same rules. It's just the underlying ranging structure might be a little bit more stupid and volatile into cryptocurrencies, but normally the indicator should absorb that and react to the same areas. So when it comes to ranges, no big deal. You can apply the same rule either in cryptocurrencies and conventional markets. Mostly I'm going to call stock market. But when it comes to trend trading, not gonna work. So you know that in Discord you guys have different levels of experience and different targets in which you must be working to reach out those goals. So obviously when you're beginning, the only goal, trade the fucking ranges. So just one more warning in here: if you're a beginner and just getting into learning my strategy or stuff like that, you shouldn't even have a look at those videos. These videos are for more advanced traders. So if you have a look at them, just make sure this is for informational purposes only. Don't use the rules in those podcasts. Eventually bear them in mind for further use, or eventually if you want to know and listen to those things, of course you can, but just make sure you don't trade that, okay? It's really important. Really master ranges first. When you get to trade cryptocurrencies only or some more speculative assets, and here we're going to take gold afterwards, this is one of those assets that can be over speculated, and in those prospects, trends will differ from the rules you know. First, take a couple minutes to sum up what those rules are. This is the rules that you see in part 1-A. This is basically, to make it real quick in here, and it's just not going to take too much time, is you do get the preparation structure coming from a major low point, all right, in which you're going to basically build first range boundary, reversal trade, experienced traders only. Experienced traders only on here to try catching the reversal and the second boundary of this range. You guys are all learning to get to catch this easy third range boundary, which is a very, very convenient trade to start getting in trading safely, safe and sound. You get to progress toward more aggressive trading, and obviously normally when you get this third range boundary, you're going to wait for an accumulation trade. So for this range to mature, either the fourth range will build itself in here or slightly higher, but anyway, that no big deal, depends on the ranging structure. On a neutral ranging context, you're generally going to get to accumulate in those areas closer to the previous resistance, all right, which means the market will consolidate, but we'll get to buy the trend channel instead of context, and then break out, diverge, pull back, final excess, and then the market has found a new safe area in which it will digest into a range and either keep on going higher or lower, whatever. We just moved price from area A to area B with this intermediate trend wave. Okay, that's how things behave. Now, when we switch to some more speculative assets, the trending structure tends to diverge a little bit. That means when the liquidity underlying speculative positioning is not there to sufficiently move price. Remember that price is offer and demand. All right, it's simple as that. It's a D structure of price stability, which means price increasing or decreasing, and trending means one of those two, either offer or demand, is significantly reduced on top of the opposite one. It's just simple as that. Too much offer for low demand, prices will go down. Further demand for lower offer is simply going to push price higher. So I know it's stupid to said it that way, but this is really what happens, and I hope you do understand what this thing is. All right. Though, when you do have less liquidity, the underlying destructurization of supply and demand will take different shapes. That's just as simple as that. That doesn't mean that the rules you've been taught previously are bullshit. It simply means that the structure of the assets you're trading is just simply different. Remember that any of the rules I teach you always come with a context. You don't apply the trend rules in a ranging context, just like you don't apply the ranging context into a trend. And that's exactly the same thing in here. You don't apply the typical trending structure I teach you that are meant to be used into liquid assets into illiquid assets. If you take your piece of paper that you must be printing from the PDF manual, I know some of you guys don't pay attention to this, but have a look at the tiny square areas you got on the top left area. You've got pre-required conditions: market to be sufficiently liquid, have enough history, volatility being sufficient enough to trade, and no big catalyst expected. So obviously, when it comes to cryptocurrencies, the first rule in here is pretty much a big infringement, because the liquidity is far less sufficient regarding the high level of speculation that can come out of those assets at some given times. The FOMO trades, to call them the way they are. At some times, people are demanding those assets with a far less sufficient offer. Okay? Which means a lot of people are holding their coin, which means just a few remaining coins are circulating with people heavily demanding them. Okay? Therefore, the trending structure in those moments don't behave the way you learned them if you were trading forex, if you were trading cryptocurrencies with a trending strategy applied to stock market, which is a far more liquid market. Okay? In order to move point A to point B in a stock market, you need to move fucking hundreds of billions. And it's not something that you just move instantly with just a few coins circulating. Okay? So liquidity is what changed the structure of trends. Therefore, illiquid assets and more speculative, therefore, like cryptocurrencies, do not trend the same way. Just like gold, when the gold demand goes stupid, when people are fearing for a recession or whatever, you generally will have those structures, those different structures emerging. It's the one we're going to be talking about today. So just to give you a glimpse of something, some of you guys might be knowing about Elliott wave strategies and stuff like that. This is a good thing, all right? Elliott wave is not a strategy. Elliott wave is more likely a helpful tool to give you some rules to trade eventually, but this is no more than that. It's certainly not a strategy all by itself. It's at best a technical context. So yeah, those who are familiar with Elliott wave, you might be figuring a lot of similarities with the Elliott wave strategy, which is basically this is going to be wave 1, this is wave 2, little noise, wave 3, and 4 and 5, all right? And in that perspective, you will say, yeah, you haven't invented anything, Theo. You just copied Elliott wave. I mean, goddammit, if you thought I invented trading, you're really, really getting it wrong. I haven't invented anything. I just pulled a few rules that I follow. It's simple as that. Elliott wave put in its own rules. If you prefer his own, then just take his. Of course, there will be a lot of similarities. Hopefully they are. Otherwise, that means you would totally be out of context. All right, so hopefully there's a lot of similarities. What I'm going to be teaching you today, if you were familiar with Elliott wave, this will help you making some connections. This is the typical third wave extended structure in Elliott wave. there is also different types of structures in Elliott wave, just like they are in my structure. Everyone adapts to multiple market conditions. In Elliott wave strategy, this is what they call fifth wave extended structure instead of third wave. And this is how they teach it for you. They will say first wave, second wave, third wave, fourth wave, and the fifth wave gets extended. Okay? So what does that basically mean? That means that in terms of duration and amplitude, all right, wave 1 is generally similar to wave 3 in terms of amplitude, and wave 5 is far more amplified and long in duration. Okay, just like in here, the first wave is far less represented than the third one. Okay, so in here you've got first wave, third wave, and a big, long, extended fifth wave. Okay? This is the simplest thing ever, all right? Third wave extended, fifth wave extended. So what is it going to differ? Does that mean that the rules you've learned from the PDF manual to trade liquid asset trends won't apply into this context? That doesn't nearly mean that. That doesn't mean that what you've learned is bullshit and that you can't use it. You will obviously use it the day you'll finally be decided to get to trade some more liquid assets, and hopefully, I hope someday you'll get down this road and not just simply trade cryptocurrencies forever. But I mean, I can dream. So the thing is that the rules you've learned, they're still working. They just have to be transposed into different contexts, because in here, some things will be slightly changing. Let me tell you what those changes will be, okay? So I just made the Elliott wave comparison in here, so you get the ground rules if you're familiar with Elliott wave. That will help you learn what I'm going to be teaching you out here. So now in a pro-indicator context strategy, I'm going to teach you how to navigate those things. I think this is far more precise than Elliott wave without being too rigid. The problem with Elliott wave is that the rules are too heavy, which means most of the time they really don't work well. So I'll try to give you my vision for this big structure that is pretty similar to the fifth wave extended of Elliott wave. So in my perspective with the indicator, what you're going to be basically seeing is that the structure starts just like every structure start, which means a major low point, which means you come from anything that precedes, range, whatever the fuck that is, and you're going to build a major low point, okay, into a major supportive area. You're going to go from context to context. That's absolutely necessary, which means in here is your support context, okay, and in there will be your resistant context. That's the first absolutely necessary rule. Nothing changes. It's just exactly the same as it is on normal conventional market trending, okay? So at that point, nothing changes. You just need to go context to context. In here, obviously, only the experienced traders take the reversal. That's the same old rule, right? This is experienced traders trade only. The reverse in here, which is the second range boundary, experienced traders only, because it's tricky to figure out and requires quite some money management. Obviously, you find your second reverse in here, which means normally the context will start going bullish. All right, and normally this is where we get to look for the third range boundary, okay? Normally we do know two resonances in a range. You know about the possibility for a bullish range to set in place in which we trade inside the context closer to a 61% Fibonacci resonance, okay? That's one set of rule. You've got the other rule, which is you wait to trade below context and closer to a 76% Fibonacci resonance, okay? Either you trade inside the context or below with 76 or 61. I'll just give you a tip in here. Those fifth wave extended structure have a slightly better chances to make bullish trending ranges. Some will just not follow these things, but they have far more. You will see way more 61% retracement in speculative assets than you will see in conventional, more liquid markets. Okay? In a normal market context, you have more neutral ranges than you'll have bullish ranges. In speculative assets, you will have slightly more 61% than 76. Okay? That doesn't mean everyone will rebound out of 61. Right? It's just to give you tips. Okay, which means you can eventually start trading starting at 61%, depending on the structures. Remember that in here you're going to need to have early trending signal, otherwise that doesn't work out. I hope you know your rules. So when the market rebounds out there, it would generally create a second wave. Normally the second wave, and in our structure, has to go higher. That's the reason why we've got better chances to reverse out of 61. Okay, but in here what follows is still a range, which means it can be complex, but in a global structure, normally the second wave go break the previous area. Okay, which means this second wave generally ends up on top of resistant context. Okay, this is when you're going to break the resistant context that you're going to find the taking profit areas for this wave. It always has to go higher than the previous one. It's absolutely necessary. Okay, and it has to make a higher low point. These are the standard rules for a bullish range. Okay, so we build a bullish range, and out of this, normally you have another set of rules similar to the one we've seen for Elliott wave. Generally speaking, this impulsive wave in here, okay, this one, is generally similar in length than this one, and amplitude. Generally, this one isn't surging to the upside, it's just looking like it is, but it's slowing down its pace into those areas. Sorry about that. So that's the thing, all right? And those waves are similar, and at that point, you can even make any difference, because we're talking about trending, but at that point, all your trading is just a range, which means you're going to apply your range strategies. You're buying the dips in here. If this has reversed out of 61%, you're going to follow the rules you've got into your beautiful PDF manual, which is on a trending range. The validation will come when you reach out the opposite trend channel, just like it is. The confirmation will come when you get to the opposite context boundary, which means this is where you're going to get your confirmation. Okay, so this is where you're going to confirm this thing, and then your targets are when you overwhelm things. Okay, so this is how you're going to navigate this thing, just following the ranging context. So the early stages of a fifth wave extended is a bullish range context. That's just easy as it is, which means the first profit trade you should make in this structure is just a bullish range trade. Something you already know. So no big deal, okay? Second thing is that in here, you obviously don't try to take the reverse. That would be just stupid. This is a experienced trader's reverse only, and this is not the trade you should make. Normally in here, if you forecast a trend to show up, you're not going to be selling. You're just going to eventually risk manage, which means profit take, to buy afterwards. What comes after into the structure is where normally you would see the trending system emerging. This is similar to what you know as a pullback, okay? So the trend pullback is going to be typically the next wave, which means, statistically speaking, it tends to behave in two sets of waves. It generally tends to retrace Fibonacci retracement of the previous wave, but this rule in here will change. Okay, that's the only difference on the pullback. Use your pullback rule, which means you need to see a mature range on the lower context, which means the lower time frame should be first range boundary, second, third, and you should be making the fourth range boundary at least, which means a mature range, retracing to Fibonacci retracement of the overall structure. All right, don't build your Fibonacci out of this low point, build out of the overall structure. The resonance in here is the same. Minimum 23% is absolutely necessary. Okay, it's generally going to be more, but you generally will trade closer to Fibonacci retracement of the overall structure, and you're going to add a little bit of spices in here because you're going to be trading the overlapping structure, which means it is closer to a Fibonacci retracement of the overall structure and closer to the previous market top of the first wave. That doesn't mean exactly there, just means closer to this area. Don't be stupidly rigid, just like Elliott wave traders are. It's just find a resonance area. The resonance area is definitely there. When you're trading in a cluster closer to a Fibonacci into the nearby action area of the previous market top. When you range your potential pullback, it's still potential at that point. You don't know shit about what this is. This can just be a range. And remember that what we do in here is a speculative entry. You certainly don't know that trend is going to emerge at that point. It's like the accumulation trade. The accumulation trade we do into normal structure is going to look like applying your pullback. Okay? With this slight improvement that it has to reverse closer to this. It doesn't has to, but most of the time it will. And that's a far good sign if we overlap. Okay? So this is how it goes. If you have trending signal, that's a pullback. Remember that what you should see in here is at least taking profit structures or blue signals at best closer to those Fibonacci. And if you have that, you buy. You also apply your pullback rules, which means generally you has to be at least 50%, you need to be at least 50% context. Most of the time in these things, you will generally find the context in here, which means you're generally going to be trading either inside or slightly below context, but you're going to trade closer to the context. So that's a significant number of informations you have out there. You're going to need to have early trending signals on momentum, favorable cycles, you need to trade closer to the overlapping area, you need to have a mature range, and you're probably going to be trading within the context. That's a shit ton of information to risk limit, right? All right, so that means you're not randomly trading, you're trading with a shit ton of information that you can process to risk limit. Are you going to have every one of those informations? Not necessarily. Some trades in here will just take 4 of the 5 rules. They won't be trading exactly at the overlap, but slightly lower, but they will have every other condition, trading at a Fibonacci, whatever. Okay, so it's not about finding the perfect conditions. You rarely have them, but using a shit ton of technical elements, rational technical elements, that you can sum up to risk limit. The problem in which you can eventually just trade what it is a range. And in that perspective, if this thing is a range, it's just going to keep on fucking you and go straight line bearish. But in here, you risk limit. You're limiting the possibilities of being proven wrong and therefore improving your chances to be proven right. But you don't know shit, okay? You'll see if the market reverses in here, the next step to validate is to return to the previous market top. Okay, this is the next time you're going to keep on validating this trade. When you took this trade, you validate it when you reach out to the previous market top. Okay? And at that point, will generally show up the accumulation trade. This is where there will be a slight bearish demand, but far more people being bullish, you included, which means generally in here, you will eventually find a little tiny accumulation trade. It's not necessary, but sometimes it will happen, which means you're going to be trading in the trend channel here instead of the context, and you will probably see the accumulation trade just like in a normal trending condition. Afterwards comes the breakout, just like typical breakouts. You will break cycles, whatever. The following action is no divergence, pullback, whatever, because we already made the pullback and stuff like that. There is no divergence in this context. There is no divergence. In here, generally, you'll have a slightly volatile area. It's generally tiny consolidation, but it is just like a little bit of noise. These areas have been generally vertical, and it starts to digest. So it's no divergence, it's more like a tiny return of volatility, and generally comes a final wave in which you reach out to your objective, to your targets in here, and normally the market reverses V-shape and build a very profound 2 sets of waves in here that generally gets to erase probably 50% of the previous move. And you just got to do exactly as we done previously. You moved from point A to point B with an intermediate trending in the meantime. It's just that the preparation in here has been longer. The moving from point A to point B is generally sharper than the other trending system. Okay? So same conclusion, same thing, just different way of doing it because of different liquidity structures. Okay? So this is how these things navigate. The problem in this thing is that the structure is slightly different, but there are some both advantages, there are pros and cons. The pros is that the accumulation is lasting longer, which means you have lots of preparation into this thing. This pro is also a con, because obviously when you're beginning, these structures are more difficult to navigate because they work harder into your impatience biases. But we're going to be talking about this into the psychological podcast that we'll do in part 2, okay? But it has pros and cons. Technically speaking, you have more available time to speculate. The speculation difficulty is pretty much the same, you just need to adapt, okay? The difficulty into these prospects is mostly concentrated into the profit-taking problem. In this structure, sometimes you will miss the profit-taking, which means the market will violently reverse and you're going to say, oh shit, I'm out. Wait for the pullback in that perspective. This market generally deeply pull back. So if you really missed the shot in here, don't try to profit take when the market goes down violently. Okay, just try to wait for a pullback. But the best way to navigate this is to, technically speaking, with my strategy, you're rarely going to have profit-taking signals in here because it's too volatile and the indicator are protected against volatility. So there will be a lot of protection that might be erasing most of the signals that you know for the final excess. Which means sometimes it will do right. You will see trending breakouts in here and that will give you the signals to start profit-taking, but sometimes it won't. And the problem is you still have to navigate these things. So option number 1, you take the pullback and you just wait for the market to reverse it all by itself. Option number 2, you make a technical analysis of your price to highlight the areas because of historical prices in which you have very likely going to be profit-taking demand. Okay? And in that respect, you take your profits on your target rather than looking for technical signals. Okay, if you do have the luxury to have technical signals, that's better, but I can tell you it's not necessarily going to be the case because of indicators protections. All right, though, we're 26 minutes in and we've done the hardest. Now we're going to move to real market applications and I'm going to give you a few additional tricks. So let's do it. So we're going to use gold first, as it seemed to be as a good example when I made it for the French guys just right before. So here is what we have, and you're going to be saying, what the fuck is this? I don't see anything. I don't see any of the fucking rules you just told me. So what the fuck is wrong with you? You just basically taught me something that is pointless. No way, it's just that, once again, there is the theory and there is the reality. The theory is, by fucking definition, theoretical, which means it's not behaving this way in the real life, but the rules still apply if you're smart enough to learn them, okay? So the thing is that the rules in here just apply. It's just that your mind and your eyes will fuck you up. So if you're learning this strategy, I sincerely recommend that you learn to delete prices most of the time because it will sincerely help you to wipe out the noise. That will basically take all your attention because you will say, okay, I see that the trend is in here, but what the fuck is all this? What the hell is that? What the hell is this? All right, this is just range. Like I told you, these trends prepares with range, which means there will be a shit ton of noise, and if you can't wipe it out, you will have problems. Okay? Reason why you don't trend trade if you don't master ranges, because flushing out that noise is something you will learn by trading fucking ranges. Okay? So in here, basically the core information that we've learned previously, they're here. It's just they're probably hidden by some fucking noise. So let's delete prices. Okay? Once again, when you want to study reasonable, interesting price movement, you have a look at where prices fucked up the trend channel. Simple as that. You know that we've gone in here, okay, we've accelerated, we've got signals detected, so you know you've got a boundary in here, and you know you fucked it up to the upside in here, so at least you know we've gone there to there, right? Then, what is the next time we moved in here? So you know you've gone there, okay? What is the next time we've moved there? And you know that we've probably gone right up here, so right to resistance context. And then we've gone there, and then we've gone there. Damn it, doesn't that look like something you know? That's as simple as that, all right? I know you might let yourself be overwhelmed by the fucking noise of ranges, but the reality is that you shouldn't. Just have a look at price movement that matters. So now that we've highlighted the underlying price structure and deleted the fucking noise, let's confirm. Do we really have done such a thing? Yes, and I haven't seen the prices to do it. So the thing in here is that, do we have our structure Fuck yes. It just has to be slightly changed in a prospect that I would personally go trending impulse, fucking range, second impulse. Okay, this is just noise. In here is a false flag. We tried to trend, but didn't break the previous resistance. So this is just a more complex range in which we've done something ugly that is barely noticeable, but let's call it that way. Okay, then comes your pullback. Where is it going? Exactly to the resistant area of the first wave, which just slightly entered into this area. So is this a big problem? No, it isn't. We still have an unperfect, but still there, overlapping structure. Okay, we probably have retraced Fibonacci retracement of the overall structure. Everything is there. I'm going to give you an additional trick, okay, that you must validate, or not must, but it will generally help you. Most of the time when you take these structures, this wave in here will terminate at the trend channel of these things, which means you take your bottom, you build a trend channel, and you generally reach out to those areas. Sometimes you would generally slightly exceed, like slightly trying to get off, but generally reintegrating right after. Okay, so tiny excess is possible in here, but generally not a big deal. Okay, that's one first technical element for those who are not using the indicator eventually. Okay, no problem. You can use trend channel; it works just as well. So what comes next is the pullback. So you know the pullback must be onto the overlapping area of the first wave, simply revisiting the first wave's resistance. The first wave fucked it up in here. This is where we build the resistance. We're now building support out of here. That is just an overlap. It's not perfect. Some people and some Elliott wave trader will say, God damn it, the overlap was in here. You just totally fucked it up. Who cares? That doesn't matter. What matters is that this is where we've built the resistance of the first wave. This is where people were profit taking, all right, in all these areas in here. And this is where we've built the support in here. We tried to go lower and we failed. So is that a big problem that the overlap isn't perfect? No fucking way. The rule in here is just respected anyway. Okay? Hopefully we had trending signals in here. Let's have a look at if we did. We did. No magic, no shit Sherlock. You certainly haven't been catching the market bottom in here, but in here you had everything you fucking needed to get into this market. You had the trending signals and everything you needed. All right, cyclical activity, trending signal, trend channel trading. Fuck this. This is exactly the pullback conditions. If you were trading a Fibonacci in here, you had to buy. The market has gone slightly lower, but who gives a shit? This is why you have a stop loss. The stop loss must have been below the previous low, which means this never has been a problem for you. All right? And just keep on riding this thing. What's next? Do you know for sure that after this entry, your market is going to be trending? No, you don't. No, you don't know. What you know is that you will have validation if the market retraces to the previous market top. So in here is your validation. Okay, and you will have confirmation when the market accumulates and breaks up. For the breakout, if you don't have the indicator, I can give you a tip. In here, generally you take the first wave bottom, or this one, all right? Generally, you can take, in here, the three levels are perfectly aligned, all right? You take the intermediate resistance, you build your trend channel, and you generally have the area in which the market will accumulate. You can also use the 0.1 to 0.3 trend line, which would generally give you the area in which the market accumulates. That's exactly what happened in here. As you can see, the market goes to the resistance, accumulate, which means it's not retracing to the trend channel, which is the lower time frame context, okay? Which means in here, you likely have the accumulation trade, okay? On the lower time frame, obviously, because in here, you're probably trading the trend channel into the lower time frame. So here's your first trend trade, here's your second trend trade. Both cases, you had trending signals, which is a good sign that risk limitation is favorable for a trend trade, and here comes your breakout. Here comes your cycle breakouts. In here, you can see cycles are broken, okay? We're breaking on top of resistant context and through the trend channel. That's a typical breakout. So breakout structure doesn't change from the structures you've known. So the breakout is exactly the same in both case scenarios, okay? You're always breaking the trend lines and stuff like that. This is where cycles are breaking. This is where the trend has emerged. This is where you won the battle. This is where you put your stop losses at break even, take the breakout trade, and let yourself ride that trend. You wait for the tiny volatility area, okay, and the final excess. and here is where your trend terminates. That wasn't so complicated to navigate, right? If you missed the shot in here, here's your pullback. End of story. It isn't that complicated. You might be saying, all right, I see, that's easy, that's easy. You'll see that the first time you try, it's not going to be that easy, because in here, first of all, you had to wipe out all the noise, which is not going to be easy. Now let's take some other examples in which you'll see that some rules have been broken, but not all of them. Okay, let's take a real nasty example right now. Let's take the good old Bitcoin. And in this area that hasn't been easy to navigate for me, I remember this area and it was really complicated to navigate. So you'll say, okay, we definitely have something in here. So in here is definitely the structure. We do have a wave 5 extended, though a trend on an illiquid market or speculative market. Very speculative, by the way. And the thing is, in here you say, wow, what the fuck? Where the hell does he plot his rule into this thing? Because I can definitely see that there is a trend, but what the fuck is that? So, just like every trend, trends can go excessive. And that's exactly what happened in here. The trend on Bitcoin is there, but it has been excessive, which means some of the rules have been altered to a far more significant upside potential. Okay? So let's talk about it. Anyway, in here, there were a different context because we were coming from a crashing market, which means in here we needed low volatility, which means the range has been freakingly complex to navigate because we had to spend some time, okay, and contract the volume. So in here the range is pretty fucking noisy and its structure is freakingly rare. We rarely see those structures, but in here the range has been this structure, which is a rectangle triangle, very rare structure, but it has been happening, okay? But you generally don't see it, but in here that's what happened. So if you would say, okay, I see the first impulse in here, there is a second one in there, but no, it hasn't been breaking the previous market top. So this is no impulse, this is just range, motherfuckers. That's all about it. It's just if you thought this was a trending signal, it wasn't, because it hasn't been breaking. Remember that you only have a look at what broke prices. Okay? So this is just noise, actually. It will focus your attention, but it's noise. This is a trending signal. So actually, this is this. So as you can see, instead of retracing, we spent most of our energy digesting pretty much flat. The two waves are pretty significantly similar in terms of length, but amplitude is far significant into the second one. So that's a shifting to the upside. The destructurization of supply and demand was far more favoring the bulls in here because there was a freakingly limited supply, because lots of freaks in here have been buying and holding, exactly like I did. So there was very limited supply because lots of people were holding the coins for far better targets. But anyway, in here I made my first, not mistake, because that's exactly what I do into those structures. I profit take. I profit took 25% in here because my goal was to just follow my goddamn rules, pullbacking on this area. All right, waiting for two sets of waves leading us to new lows. But what did we do instead? Two sets of waves to the upside, which means in here the supply and demand was so irregularly splitted that basically instead of going to pullback, we've kept on pullbacking to the upside. It happens. You know that in some rare structures on the trend, okay, at some point in some trends, regular trends, you will have your trend happening in here, and the pullback, instead of doing this, sometimes will do that. That happens. It's very rare, but it happens. That means the market is very bullish, and that's exactly what happened in here. Instead of pullbacking, we pull back to the upside. But the trend channel, still the same rule, all right? We've gone trend channel in here, and this is where we broke it. It's as simple as that. This is where we somehow pull back to the upside. A tiny accumulation in here, real tiny. This means that there was not that many bears, and bam, breaking, volatility, and excess. Though the trend actually terminated here. This trending move terminated there in its wave 1, wave 3, wave 5 extended structure. This is just excess. This is an excessive market. This has been bubble wave. Okay? So remember that these trends are not bubbles. Bubbles can emerge from this trend because they are favorably generally exponential thing, and they can lead to excess. So statistically speaking, excess shows up far more often in wave 5 extended structure than they do in conventional liquid markets. For an obvious reason, the more liquid the market, the far less probable are the structures of bubbles to emerge from them. But obviously when the market is illiquid, heavily demanded, and the supply is heavily limited, this is where stupid trading can occur. And that's exactly what happened with Bitcoin. Personally, I thought 9.2 was a far reasonable target for this market to move upward, and that we could have ranged in here before going higher, obviously. But instead, people were overbursted and overexcited about this thing that they decided to keep on buying stupidly right up to 14 fucking K. And no one have anticipated this target back in those days because it was so stupidly irrational. So what we've done in here is just an excessive bubble market. We've gone bullish in here, and that was absolutely normal. This was bubble. This was an additional stupid wave of people just wanting to buy something they doesn't even know what that was. And have we sustained those valuations until then? Absolutely not. This is something we crushed out. This wasn't mean anything because this was stupid. This was meaning something. That's why I always told you the 8.9K area, the 8 to 9K area is a very, very dense cluster because this meant something. And if we can restore these prices on bullishness on Bitcoin, that will mean something. Okay? No, last but not least, we're going to take a real-time market analysis in here because that's analyzing the past. But the goal of making this analysis is to show you that if you are to formalize into your rules, you're somehow going to miss those things. Don't be too rigid into the way you approach these things. In here, you might not necessarily figure it out at to be a fifth wave extended trending structure, but actually it is. In here, the flows that fooled you, is basically that this ranging structure is pretty unconventional, all right? And that this pullback in here is a dynamic pullback, which is rare, but still happens. So in here you would say, yeah, I think this is an accumulation. No, actually this was the pullback, and the accumulation is just barely happening in here before breaking. Okay? So in here it's just that either we skipped the pullback and this was the accumulation, but anyway, this structure is not conventional. We shouldn't have seen that. We should have seen this and this. Okay? Technically, though, remember the key element. What I'm teaching you is not how to read the market. I'm teaching you the resonating structure in which most of the time markets will behave, which will give you a tiny but very important statistical advantage into trading. That's all I'm teaching you guys. I'm not trying to teach you how to read every market and how to forecast every market move. The market remains and will forever be unpredictable. This is one of the many reasons it can be unpredictable. But did I manage to navigate this trend anyway? Yes, it's just that I wish those 25% profit would have been reinvested in the pullback. Just couldn't do it. Okay? So now let's go Ethereum on a 4-hour context and see the real-time market. And why am I telling you to have a look at Ethereum right now? Obviously know about the context. We're dealing with coronavirus, all those things. So remember that we don't use things out of their context. In here, obviously the context is freakingly blurry as hell. We don't know anything about what's going to happen in a month from now, so it's difficult to trend out of this. Still, does that mean I see the structure in here? Yes, I do. And I hope you do as well. At least I hope you're going to be learning how to do it. If you're having troubles as well, think about deleting prices. You know that we've gone there. This is where we fucked the trends. Okay, so this is where we probably build a major low point, which we care. It has to happen into a major low point, okay, which I told you. We were in a technical possible major low point area. So what can I say next? Okay, we probably have gone there. I can see arrows. Okay, probably have gone somewhere in between. Here we gone there. I can see we broke. Okay, right up to here, and then here, probably here, and here. Oh shit! Doesn't that look like something we know? Yes, it does. All right, we have touched a major low point. This was an experimented traded deal only. Others don't try to catch this thing. This area was only a profit taking for those who bought this. This was the typical third range boundary, but this one has been complex to navigate. So this is where the flows have been hidden in here. This is in this area that things wasn't easy to figure out. Let's just put prices back on the game. So do we have the first bullish wave? Yes. What the fucking range does look like is where the problem has in here. Instead of making a classical ABC structure, we've made an ugly triangle. So in here, the problem is the ranging structure has been unconventional. That's what made this structure more difficult to highlight, but you need to navigate through noise. That's absolutely necessary. The second wave in here, similar to wave one, has a very, very unconventional way of building itself because it has pretty much built into two sets of waves, which normally isn't the case. Normally into those structures we tend to go straight line. In here we can see that we're hesitating a lot more because the bullish structures tend to build in two sets of waves, which is not totally favorable, but so far all I care about. So it's not perfect, but we do have two sets of waves to the downside, retracing to Fibonacci level, trading on the trend channel, and going overlapping levels. So do I have significant informations in here? Yes. Have a look at the cycles, have a look at the signals. All of those things are favorable conditions. Does that mean that we meet all the requirements? No, but we do meet a significant number of them, which means, is this area interesting to speculate on a pullback? Though in here that's a pullback eventually preceding a trend because we're building on a fifth wave extended. So the pullback is not signaling the nearing end of the trend, but the nearing beginning of it. So what we care about this thing is, do we have enough risk limitation to try getting in that perspective? The answer was yes. The next thing is what I told you. The next step is returning to the resistance. So in here is your validation. You return to your resistance. What do you start to see? Breakouts. These are significant confirmation signals. This is not done yet, but this is favorable signals. So what's next? The first good signal now would be to keep on going higher. A bad signal, right? A risk augmentation signal would be returning to the trend channel, but that wouldn't nearly be the end of the world. All we need is not to break these lows, okay? But if the market just keeps on going, we're dealing with the resistant context, the trend channel is here. Don't you think that we can have an accumulation somewhere in here and breaking these areas afterwards? Yes, that's what I mean. We do have significant probabilities that this market will break these areas if it goes up here. Do we have the trend line? Yes. Where are we trading? In here. So if we go up, you know that in here there will be an accumulation trade. Obviously there will be one. Which means the last time you were able to trade this asset is not buying stupidly right here or whatever. It was one trade in here, eventually another accumulation trade forthcoming, and then the breakout trade. So if you want to ride that trend, you don't buy right now. You just wait in here to see if market rebounds in here, and you'll know that you have significant probabilities for the market to accumulate into this area before breaking up. The breakout level, very likely going to be from $200 to $210. And this is where you probably see the market breaking cycles and fucking prices to the upside. What's going to come right after? We're going to push stupid until we get a little bit of volatility, and then you take your profit on the next wave. End of story. That's how it goes. That's as simple as it is. It's not complicated. There are some risks because obviously you never know for sure, but as long as the structure follows the resonating system I taught you, you need to follow it. That doesn't mean this time will obviously work, because there are clearly some signals that are not perfect. I don't really like the fact that the upward waves are made by two sets of waves. That's not a very bullish sign. So I would tend to say that in terms of risk management, it's definitely not perfect. You might not expect something exploding in here just like Bitcoin going 14K, but you might expect a fifth wave extended, which means a trend, and a trend always breaks a resistance. So anyway, we'll see about that. That's just a future scenario in here, but I wanted to make this job of analyzing. There are some risks. The structure isn't perfect. Just the goal in here is to let you understand that the structures will rarely be perfect. What matters in risk management is not to get the full check of all sets of rules, but most likely to see how many you have, how quality the signals are. Risk limitation is not about perfect. Risk limitation is about getting decent risk limitation. Okay? So in that perspective, I think the signals are decent enough to trade, not decent enough to go all in, no decent enough to risk a lot, but decent enough to risk like 1.5% on this trade with clear levels of invalidations. Okay? Though that being said, I hope you guys finally will be able to navigate the crypto market with the trending strategies I taught you. Remember once again the warnings I gave you earlier into this podcast. You don't trend trade if you don't master range trading first. That's an absolute necessity. But if you're dealing with cryptocurrencies only, then you can use this strategy for trend trading. This doesn't belong just to cryptocurrencies. It happens on, like I said, very illiquid assets in which generally a lot of well, let's call it that way, a lot of unconventional traders demand. So either assets that are traded by retail traders, so cryptocurrencies is exactly the case, and gold in the 2016 bubble was exactly the same thing. People were buying gold, they didn't even knew why, but that's what it is. So when you have a liquid market or speculative, which means heavily demanded by retail, that generally means that prices may react with a little bit of stupid pricing, and that means you might be seeing some fifth wave extended. That happens to the upside and to the downside. Remember that there are downside trends, which means the upward fifth wave extended exists, just like the downward fifth wave extended exists. And by the way, you might be seeing one in here, right? So this one has been catalyzed, so this is not something you must be paying a lot of attention to, but don't get me wrong. Overlapping structure, trend line, accumulation, breakout, acceleration, stupid pricing, whatever, all right? This follow the rule as well. But the problem is this one has been catalyzed, so it was totally unpredictable, but so I wouldn't call it that way. I would most likely call this one a volatile, unexpected market catalyst rather than a trend building itself, okay? So we'll see. Eventually this thing is either bearish or bullish, and it will do basically quite the opposite. Like you can eventually just take that and plot it into the opposite direction. And eventually what we'll do in here is just trending there and stop. And we'll just do the exact opposite of what we've done before. That's a very, very likely possibilities for Ethereum. Because this is where we've got the resistance context on the higher time frame. Okay, anyway, we're not there to talk about Ethereum, but I hope you do understand this thing. Okay? Trend isn't easy, and remember that anyway, all of those things is just multi-time frame layers of mess. Okay? Okay, see you guys later. Hope you have been learning something today. See you further in time for part 2.